Good morning and welcome to Stock Market Today. It is Thursday, May 14th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where I get a lot of the content for this show. It also gives you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities were lower in Wednesday's trading and kept with a recent trend of closing near the lows of the day. All sectors were down, with energy, financials, and industrials as the worst performers. Treasuries were stronger with the curve flattening. The dollar was weaker on the yen cross, but better against the euro. Gold finished up 60 basis points. WTI crude down 2.5% on the day. As we get to the desk this morning, it's a mixed session. S&P futures are down about 20 basis points. NASDAQ futures are higher. That's after U.S. equities came under pressure once again yesterday. Asian equities were lower overnight, and European markets are under pressure today. Treasuries are stronger with the curve flattening. The dollar is stronger against the euro and sterling, but weaker on the risk-sensitive yen cross. Gold is up 50 basis points, and WTI crude is up 3.5%. So the S&P 500 pulled back and tested that 2,800 level, and it's holding for now. That's one of the top end of the range that we've been highlighting as support. So initial support remains in the 2,750 to 2,800 area. Below that, you have to start thinking about 2,485 to 2,660, and obviously, if we start to move towards those levels, we can fine-tune with a little bit more precision, or what we think is a little bit more precision. Resistance remains in the 2,950 to 3,000 area. Notice the 200-day moving average continues to decline. 13-period CCI with a 3-day moving average, not overbought, not oversold, but Chaikin money flow has dipped into bearish conditions. So mixed indicators with a slight downside bias. 2,800, the key level to watch here. All eyes are on it. At this stage of the game, I do think it's a little bit more of a zone between 2,750 and 2,800, but 2,800 does remain important. What's interesting to me is some of the key areas that are beginning to break down. We looked at transports yesterday. We'll look at materials today. In my note, I kind of highlight a basket of areas in the market that I think investors should pay attention to see signs of increasing participation in the market, and we're just not seeing it. So our market in a minute. What are we writing about today? Recent trend of closing near the lows continues. It's the 5th time in 7 sessions that the S&P 500 closed near its lows of the day. Breadth remains weak, and there's a short-term divergence at play at the 20-day moving average and that metric. Materials, part of a weakening reflation basket of funds that we're watching. Large cap growth is a focus area, should support hold, and then futures, as I said, do point to a mixed open here today. Major indices from a power bar perspective, some deterioration. The Dow down 2.25%, 1 to 13 bulls to bears. S&P 500 down 1.8%, 38 to 174. That ratio weakening on the day. NASDAQ stays positive despite being down 1.25% yesterday. And small caps, big underperformers once again, down 3.4%, 260 to 378 bulls to bears. Bonds uptick and a bit of a flight to safety, which is kind of interesting to me in light of Chairman Powell's comments that negative interest rate policy is not on the table at this time for the U.S. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. So let's dive in now to our stocks of the day, sticking with this trend of kind of using Thursdays to identify what I think are interesting screens. Remember, last week's screen was weak bank stocks, and they've just gotten weaker. This week, I'm kind of looking at large cap growth names that have the potential to outperform should 280 hold for the S&P 500 or for the SPY. So kind of drilling down on names that are very bullish and bullish at Chaikin Analytics that are members of the large cap growth group that also exhibit strong money flow and strong relative strength. So you can take a look at some of the names here that are interesting, right? Regeneron's a name we've been talking about. PerkinElmer, right? For those of you who listened yesterday to The Pitch, the new show on Stock Charts TV, I talked about this name right here to you, Adobe, Amgen, a lot of household names here that are, continuing to be strong in the large cap growth space. that I think makes sense to have on your radar screen, right? And if the market does hold this 280 level or 2,800, just kind of the key support areas that we've been highlighting, I think these are the types of names that you want to consider as long ideas, right? We know breadth is narrow, but by focusing on what's leading, your odds of outperforming increase, in my opinion. So this is an interesting list of names here. Because it's not just tech and kind of healthcare that you would think. There's a lot of other interesting names here that makes sense to take a look at. So our stocks of the day is this screen that I'm running for names that could potentially continue to outperform should the market hold support. Taking a look at our sector tracker now. The movement of the major sectors over the last 5 days. Only 3 groups are higher. The utilities are coming on a bit of late with a little bit of defensive positioning, it seems. Comms continue to be strong, and staples snapping back a little bit of defensive positioning as well in the near term. Tech and healthcare still towards the top of the list, but have now turned lower over the past 5 days. Discretionary materials and energy are middle of the road. Materials, energy, industrials, right? Areas that should be in focus if you're looking for broadening participation and if you're looking for that reflation trade. And while they did rally initially off the lows, they are beginning to roll over. We talked about the breakdown again yesterday in transports. We'll take a look at materials a little bit later on in the show. Financials continue to be weak. Banks driving a lot of the trading there. We kind of hammered that point home late last week. When I showed you that screen and I highlighted the banks a couple of times in my notes last week, and then real estate is just a hot mess at this point, considering everything that's going on with COVID-19. Now, our industry focus is kind of interesting because it's one that we want to pay attention to, and we're looking for reasons to warm up, but they're just not there, right? The oil and gas equipment services group, XES, the ETF that tracks that group, lagging the S&P 500 by over 48% over the past 6 months. And the power bar ratio, which looks at future potential, is very weak. Only 1 bullish stock for 15 bearish stocks. It's currently ranked number 15 of 21 subsectors. Has actually moved up 2 slots over the past week, but still not enough there to get me super excited just yet. Drillquip, DRQ, Core Lab, CLB, and Valaris, VAL, are indicative names here, all with very bearish Chaikin power gauge ratings. And if we take a look at the fund, right, listen, this is the stabilization that we were started to kind of pique our interest, especially when crude oil prices were coming under pressure. But the fund itself, I can't get there yet following a disciplined process, right? Bearish ETF power gauge rating, very bearish ratio, weak trend below the declining long-term trend line. From a tactical standpoint, it's a little bit more mixed. Overbought, oversold indicator, middle of the road. Chaikin money flow trying to turn bullish, but look at the underperformance. The underperformance is just not there, right? We try to see a little bit of an increase, right? If you squint really hard, you can see this line beginning to move higher, but not enough to get me excited just yet. So when I just kind of take a step back and look at what I have here, I have a bearish fund that's underperforming the market. Potential signs of stabilization, but me with a kind of a more trend following discipline, I need to see more to get excited about this group. And I'm just not seeing it there. I'm not seeing it enough in the technicals. I'm not seeing it in the fundamental underpinnings of the holdings. So that can obviously change. I'm just not there yet for the way that I view markets. Taking a look at yesterday's trending names, yesterday's gainers and losers in the S&P 500. BLK announced terms of a secondary offering, stock higher by 6.9%. Regeneron just continuing a strong trend. Go back and look at that screen of names. Regeneron is on it. Equinix priced a secondary yesterday. That stock traded higher by 2.25%. Newmont is ramping up production in one of their facilities in Mexico. That is a bullish stock. The gold miners have been strong of late, up 2.25%. KSU reported some rail traffic. It's a very bearish stock here, but the rail traffic numbers sent the stock higher by 2.1% on the day. Loser side of the board, National Oil Well Varco, down 10%. Didn't see anything company specific there, but will note that they did catch a downgrade here this morning. Stock down 10.7% yesterday. Under Armour continues to be weak after their earnings announcement earlier in the week, down 9.73%. Noble, NBL, another energy stock there, Nothing company specific driving 9.6% out of that name. Tapestry. The retailers and the apparel names and the footwear names were just weak yesterday, right? Under Armour down, Tapestry down 9.5%, in sympathy with that group. And SL Green, part of that real estate sector, very bearish rating here at Chaikin Analytics, down 9.25%, to trade at a 52-week low yesterday. All right, so let's talk about it. On Thursdays, we talk about breadth. We dive into the charts and just kind of looking at the percentage of stocks in the S&P 500 that are above, certain moving averages, respectively, for the individual names, to get a picture of breadth across different time frames and trends, right? So the percentage of stocks above their 200-day moving average just continues to struggle getting through that 30% mark. Again, we started touching on the fact that the breadth dynamic coming out of this low is much different than what we saw coming out of the December 2018 low, right? Breadth quickly rebounded and continued to move higher. Now it's struggling to get out, right? Not getting that upside traction that you saw in early 2019 after that December 2018 low. What's interesting to me is that if you go back through history, what we're seeing now is kind of more of the normal behavior, right? The move out of the 2018 low was the anomaly, as far as I'm concerned. Generally speaking, when breadth gets as washed out as it did in March, it's a longer slog back. It's a tougher road to travel, and that is largely playing out. And a continued breakdown here below 30 would be confirmed, with a move through that support level on the S&P 500 that we've been highlighting. On the more intermediate term, the percentage of stocks above their 50-day moving average, struggling to gain upside traction here now as well, back down around the 50% mark. So again, very similar, not seeing the same type of thrust up and out that we saw coming out of the December 18 lows, more of a slower grind, more of a U, right? Not getting the upside traction that you would want to see to kind of argue that prices are going to go a lot higher from here. And then interestingly, on a very short-term basis, in my note today, I highlight the fact that the percentage of stocks above their 20-day moving average has moved drastically lower over the past week and did not confirm recent highs for the S&P 500. The indicator topped on April 17th. The market continued to move higher while that indicator was making lower highs. So that is a negative divergence. That negative divergence is now in play. So we really want to watch that support zone that we've been highlighting for the past couple of weeks here on this show and in our notes. We're wondering if investors will defy the Fed, right? Chairman Powell, as I said, spoke yesterday where he kind of reiterated his view that he doesn't see going to a negative interest rate policy. But remember, these bonds trade, right? So investors could kind of force the issue, if you will. Just taking a look at the IEF, the iShares 7 to 10 year Treasury bond ETF, consolidating after making that high in early March, holding above the 50-day moving average, holding above the 200-day moving average within that consolidation. And, I think odds favor an upside resolution here. 13-period CCI rounding out of an oversold condition. Treasuries still outperforming relative to stocks here. As we take a look at IEF relative to SPY, kind of holding support and now beginning to move higher. So a break higher for the Treasuries would force yields lower, the market-based yields, that is. So it's kind of an interesting dynamic at play that I'm paying close attention to within the fixed income market. And then finally, like I said, we'll take a look at the materials here. I think, materials, industrials, transports, right? Things of that nature are what you want to be paying attention to see broadening participation. And what I'm seeing is failure at resistance and now possible breakdowns. XLB has a neutral ETF rating, only 2 bullish stocks, 15 bearish stocks. Can't get much upside momentum based on RSI and continuing to underperform the S&P 500. So that'll wrap us up for today. I'll be back tomorrow.